AI is like your friend. It
Right.
should not be the decision maker. And,
Yes.
I think a lot of people are looking at this as, what AI can take the role of something. We look at it as this is just help us speed things up, but now it comes down to the decision. And you still have to do the things that venture capital does. We still have to research the team, their backgrounds, the IP, what are the patents, how are they protecting their moat? There's a lot of stuff that the human diligence is still there.
Welcome back, passionate investing community. Today we'll dive into the exciting world of startups and venture capital. Sherwood, also known as Woodie Neiss, is a venture capitalist entrepreneur and one of the architects of the Jobs Act, that landmark legislation that legalized investment crowdfunding in the United States. And as co-author of Title III, he helps you unlock startup investing for everyday Americans, reshaping how early stage companies raise capital. His latest book, Investomers, explores the transformative rise of customer investors, people who don't just buy from a brand, but believe in it enough to fund its future. Blending policy insights with real world case studies, the book reveals how companies can raise capital while building deeper loyalty, brand advocacy, and community wealth. It serves as a modern playbook for founders, investors, and policymakers navigating today's participatory finance movement. Woody has testified before Congress, advised 40 plus governments, and the World Bank, and has been featured in the Wall Street Journal, Forbes, Bloomberg, and Fast Company. So, a little bit about the book. What if your customers became your investors and your biggest brand advocates? Today's guest, Sherwood Woodie Neiss, has helped to rewrite securities law to make that possible. So, what I want to do is we're going to talk about a lot of things today. We're going to talk about crowdfunding. We're going to talk about venture capital. We're going to talk about how all these things really fit together as part of his plan, part of his investing portfolio. And most importantly, we're going to talk about the social impact, because it's not really about dollars and cents. This is about the ability to fund all kinds of companies that may have been falling cracks in the past. So with that, let's now welcome our star guest, Woodie Neiss. Welcome to the show.
Hey, thanks, George. It is great to be here. Thanks for having me.
All right. Well, it's a great pleasure to have you here because this is a fabulous story. And I like to always start with an icebreaker. When you're at a cocktail party and someone asks, what do you do? How do you like to answer the question?
Oh, I have multiple answers. I usually tell people these days that I'm in startup venture capital. Makes it easy because then
Love
that
it.
segues into everything else.
Simple answer, almost the conversation on her.
Right.
Right. Wow. That sounds very complex. And it is, of course. So, what I'd like to ask you, I mean, you are involved in all of these very diverse ventures. So, how does it really all fit together for you? It's really all about funding startups.
Yeah, so we were instrumental in the creation of the law that enables startups to raise capital online. From there, we built a database that aggregates information on all these companies that are raising money. And so we look at things like where they're located, their financials, their valuation, but we pull in things that are unique and new in the private capital markets, and that's investor sentiment. So every day there are companies raising money through what we call regulation crowdfunding, and they're on over 100 platforms that are registered with the SEC and overseen by FINRA. And we're tracking each of those offerings each day to see how much money is being committed to them and how many checks are being written. And with those two numbers, we can see which deals are hot, what industries are cooling, the average check size, if it's growing, and we're following the crowd signals. So where a lot of people are going in a deal, we're saying, what's going on there that we should be following? So the database itself now lends us to do a ton of other things that we do. One of them is research and reporting. So we do all this analysis on the industry itself. Another thing that we do is we built a venture fund that is based off of an algorithm for the entire data set. So we built the algorithm to look for signals of companies that are most likely to go on for follow-on round. Not that they'll be successful, but a signal is you've hit milestones, and so we look for those
Right.
milestones in the data set and we invest through them. Like I said, like you said, I wrote a book called Investomers
Yeah.
about the whole thing. So we're touching on so many different aspects of the industry.
Yeah, beautiful. And, I'm glad you mentioned that database because I know you've gotten a lot of really interesting insights out of that. So you want to just share one or two?
I mean, one of the things that I think is absolutely amazing about this. So when we were at the White House for the bill signing ceremony,
Mhm.
President Obama was the one that signed it into law. He referred to what we did as a game changer. And he said, what these guys pulled off in 460 days is nothing short of a miracle. And one of the things that he said that we were saying when we were going through the halls of Congress is this will democratize access to capital. So you don't have to be in Silicon Valley. You don't have to be in New York City or Boston, one of these money centers to get capital. Right. You can be where I am, like in Denver, Colorado, have a great idea and raise money from your community. And now that we have the data, we can see what that community looks like. And we track where there's women or minority founders on the team for the companies. And what we've seen, particularly last month, 50% of the people that were raising money had one woman or minority founder on their founding teams. Now, those type of individuals, if they were to walk into a VC door, A, probably wouldn't get an introduction or get into the door, but B, probably wouldn't get funding. Only 1% to 2% of all venture capital goes to women and minorities. So the fact that 50% of the people coming through regulation crowdfunding are women and minorities, I think speaks volumes to the fact that this really is doing that. It's democratizing access to capital. The other data point that I think is really, really valuable is if you look at the latest valuation of the companies that have raised money through investment crowdfunding, and a lot of these companies haven't had the exits yet, but the exits are forthcoming, it's over $90 billion of value. So there's investors that have invested in these companies through regulation crowdfunding that are going to be millionaires because when they have their exits, that money is going to be returned to them.
Yeah, beautiful and great insights. A couple things there. I noticed you do have a sort of a comprehensive database here. And that's one of the things that really had been lacking for a long time in the industry. I know that from the academic studies that I've read, they tend to focus only on angel groups, for example. So if we can kind of take a step back to the seed stage, because I know you're investing really spans everything from seed to Series A. So are you able to dig in there and find some additional, I should say, what is the success rate of crowdfunding versus, say, angel investing or an angel group?
I mean, that's a really good question. So, I mean, there's a lot of greatness about investment crowdfunding, and then there's some problems with it.
Mm-hmm.
When we created the law, we had to put in there that companies have to hit a minimum funding target in order to get their capital. We thought people would be responsible and set realistic funding targets. Little did we know that this would be a way in which people might game the system. So people set artificially low funding targets.
Right.
We've seen them as low as $10,000. You cannot really scale a company with $10,000.
Right.
And I do not like the fact that some issuers are doing that, and platforms are helping issuers sort of get by with that. So success rate, when you measure it based on the way the law is written, tends to be very high because it's very easy to hit that 10% funding target. So we have a lot over like 80% success rate, but realistically, it should be a lot lower. But these companies are hitting their minimum funding targets, so they're getting their capital.
Yeah, fair enough. Well, now that sort of calls out a sort of distinction. I know that a lot of people may have heard of Kickstarter or Indiegogo. There's a distinction between those two platforms and how they work. And I don't know if you want to call that out or.
Yeah, so what I'm talking about is debt and equity crowdfunding. So it's very different from donation and rewards.
Right.
Kickstarter and Indiegogo is rewards crowdfunding. Kiva is donation crowdfunding. GoFundMe, donation crowdfunding. What we're talking about is the community is either loaning money to these entrepreneurs, small businesses mainly, instead of going into a bank, and they earn a yield on that, an interest rate. Or you are acting as a mini venture capitalist and you are buying equity in these startups and hopefully have the same type of exit that a VC has in 7 to 10 years.
All right, great. Well, I'd love if you could sort of help us get our bearings here by walking us through the history of crowdfunding.
I mean, that's a great question. And I should probably step back for a second and tell you a little bit about myself. I started on Wall Street. I went to Silicon Valley. I worked for a VC funded startup there that was hyper growth. I not only learned about, the role of venture capital in funding startups, but I learned best practices by watching them scale. I then left that company and started my own healthcare technology company called FlavorRx. We flavored medicines for children so they're more compliant. We were also venture capital funded. But the thing that made our company unique is we solved a huge problem for mothers or fathers, anyone that had to get their kids to take medicine. The kids would put up a fuss.
Yeah.
Parents would go get their medicine flavored with FlavorRx. They'd call us and say, how do I invest in your company? I could never get my kid to invest. And I didn't get one of these calls. I got hundreds of them. And I kept on thinking, you know what? Why don't I turn them into investors? Because they're going to be doing brand advocacy. They're going to tell everyone, like, I just invested in this company. They solved this huge problem for me. This is what we need. And what I also realized at the time is that that's not what venture capital can do. I mean, unless you get millions and millions of dollars from them and try a whole nationwide marketing campaign, but then you might be selling off your entire business. And of course, at the time, you couldn't do that because the securities laws written in 1933 precluded the average American from investing. So when we sold FlavorRx, that was the impetus for investment crowdfunding. It was 2007. There was the Great Recession. Washington, which is where I was living, was looking for jobs. And I said to two of my friends, I was just like, we've all created jobs for our companies. Let's just get capital from the average American in and turn them into brand advocates and help them scale our companies, and then we'll hire more people. And that was how we went down to Capitol Hill with this idea that was 8 bullet points turned to an 8-page framework. But it was literally, how do we flip the script? And how do we not just take money from investors, but how do we turn these investors into influencers for us? And I think that is the evolution of really the web as well, because Web 1.0 was like information, 2.0 was sharing information, 3.0 is how we're interacting with each other in information. And I think we're at this evolution now where we're merging the people. I mean, we see it on TikTok, these influencers that are making us buy products or service. The next evolution of this entire industry that we're in is turning these investors into influencers, or what I call influivestors, that are going to be out there saying, I just invested in the coolest company. They solved this problem. I'm an investor now. I can't wait to help them grow and get my own exit from it.
Yeah, so I love that because that's a perfect example of a company that's ideally suited to this investor model. You have a company that has wide reach. You've already got your product out there, at least a minimum viable product, and you've got a large number of very, I should say, excited or almost manic supporters. So what would be an example of a company that may not be well suited to crowdfunding?
You know what? Before I would have told you a technology company that did, digging for minerals. But the fact of the matter is, when we launched this industry, we thought it was going to be Main Street, small businesses that wanted to borrow money from their local community and software technology. So now that we collect information on all these companies, we've seen over 500 industry groups, Neiss groups, where they're out raising money. And so it's not necessarily where it doesn't apply, it's where do you have a community where this can apply? And through our venture fund, we've invested in a company called EarthGrid, which uses plasma technology for boring through the earth. Why would you ever think that would be a great idea for crowdfunding? But they've got a passionate group of scientists. And this is the coolest thing about investment crowdfunding is it's not necessarily your average Joe that's investing in these deals. It's the community of people that are around these businesses that are like, I love what you're doing. I know exactly what you're doing. I want to be an investor in it. And they couldn't before because it was only limited to venture capital or private equity, but now they can. And so, it's just the spectrum's all over the place. This past year, we saw more healthcare, life sciences, and biotech companies raise money through investment crowdfunding than we ever seen in the history of the industry. It's only been around since 2016. But I think that proves the point, which is, healthcare, when you think about life sciences, particularly the companies that are working on new drug development, okay, they've got to go through clinical trials and all that. But what we're seeing is the people that are backing these companies are other doctors, other PhDs that have done similar research. And they're like, I know exactly what you're doing. I think, what you're working on, and they dig into the IP, they dig into the patents, they see what they're doing, the market, and they're becoming investors in these companies. So, before I would have thought it was niche. And now I think anyone can use this.
Yeah, I love it because you are reaching other industries. So, are there any industries that are particularly suited to taking advantage of crowdfunding that may have been underserved by angel investors and venture capitalists?
Yeah, I mean, that's another great question. So, venture capital in particular, they're looking for the home run. Okay. So, where are they going to have this billion-dollar market? Where are they going to have this massive exit? And that's where they're focusing their energy. I think with investment crowdfunding, you can have businesses that are ripe for acquisition targets. So, we're in this age of AI right now, and everyone's applying AI to whatever they're doing. We looked at this company that was using AI in relation to career development. Okay, so you're looking at them, you're like, they've built this amazing technology that integrates AI and allows companies to actually facilitate the entire hiring process much faster. Boy, they would be a great acquisition target for, maybe LinkedIn. And so it changes the mindset where you're thinking, you don't have to be thinking like a VC for the home run. You should be thinking of what is the short-term exit for some of these companies? And do I think there's the potential for them to be acquired? So
Right.
the one thing I will tell you to keep in mind, though, is investment crowdfunding has a cap. You can only raise up to $5 million a year. So if you are a deep tech, if you are in utilities, this isn't something where investment crowdfunding will work for you because you're going to need more than $5 million. Now we're actively
Hmm.
working in Washington, D.C. right now to increase that cap up to $20 million, which will bring in a
Right.
completely different profile of company. But that cap does sort of max out the type of issuers in the space.
Right. To be clear, though, I believe your later rounds, though, you can still raise funds on top of this, correct? So if you can get going on $5 million, then that's a good idea, potentially to go through crowdfunding. Yeah.
Absolutely. So, raising money is not a one size fits all. We've got these quote unquote exemptions under which you can raise capital. Investment crowdfunding is one of those pathways that you should consider using. And it fills a sort of a niche in the marketplace. But, once you graduate from there and you need, deeper pockets and all that, that's where your angels or your VCs come in. That's where a typical Reg D offering might come in, where there's no cap on what you can raise. You can also do a
Right.
Regulation A plus offering and raise up to $75 million online. So there's all these other avenues after which you graduate from investment crowdfunding.
So I'm glad you mentioned Reg D and Reg A because I think that a lot of our listeners and viewers, they tend to either operate or invest in those vehicles. So what are some of the other differences between the crowdfunding and say like Regulation D 506C?
So Regulation D 506C is a form of crowdfunding, but it is only with accredited investors.
Hmm.
So you can do what's known as general solicitation. You can use these online investment platforms, these crowdfunding platforms, and now you can solicit your offering to investors all across the United States, even globally, but you can only take money from accredited investors. Regulation crowdfunding is very similar in the sense that you can raise money from accredited investors, but you can now include your retail investors. Regulation 506C does not have a cap on how much you can raise.
Hmm.
Regulation crowdfunding has a 5 million cap. Now, what the difference between a Reg A offering, a Reg 506C, and an investment crowdfunding is a Reg A offering is a qualified offering by the SEC. That means you're going to be submitting a huge prospectus to the SEC with information about your company. This is not a small deal. This is a big deal. You've got accountants and lawyers. You're spending probably well over $100,000 on fees related to putting this offering together. And you're going back and forth with the SEC over many months where they're critiquing your offering, pulling it apart, asking questions to make sure that you've answered all the questions that they think investors might have or need access to in order to make an informed decision. When they qualify it, they're not saying you should invest in this. They're just saying you've answered all the questions we think are necessary for an investor to make an informed decision. So that's going to take you a much longer period of time to get done, and the cost is just going to be in a completely different category than
Exactly. Yeah. So then to contrast that with crowdfunding, you have sort of a moderate amount of paperwork that's required.
you can get a Reg CF offering up in as little as 30 days.
Right. And I think I looked at the Form C. It's only about, let me see, I wrote down the number of pages. I want to say it's 26 off the top of my head. So it's not crazy.
It's not crazy, and a lot of those are data fields. So you're just completing a data field and moving
Yeah,
on to the next one.
makes sense. And then for newer founders that wonder, but how can I keep my table from exploding?
That's a great question. And that was an issue when investment crowdfunding first started. And it was one of the things where people were saying VCs will never get on board because they don't want a messy cap table. So in 20, I want to say it was 2021, or maybe 2022, the SEC now allowed for the inclusion of special purpose vehicles on a cap table. So when you're raising money through a Reg CF round, you can group all of those investors into an SPV, and that SPV votes with one vote on the cap table. So it streamlines the process. It doesn't, no one's watered out in their vote, but the SPV is all voting together, and it makes the communication a lot easier. And actually, it makes it a lot easier for VCs or an acquisition to take place because they're only working with one person on the one group on the cap table at that point too.
Yeah, awesome. Well, I think that before we leave crowdfunding, I want to ask you one more question. So, do you have any other initiatives you're working with on Capitol Hill?
Well, right now we're actively trying to get the max raise from
Right.
5 million to 20. But other things that we're promoting are, if you look at where crowdfunding is working on a global scale, you'll see the UK has a very advanced crowdfunding ecosystem. One of the things that they have that we do not have here in the United States are tax credits and tax incentives. So they actually have tax rebates. Like you can invest $1,000 in a business, and the government over there will allow you to write off, up to half of it in the first year that you make that investment. So what does that do? It encourages people to make investments because they get 50% of it back on their tax return. The other thing that they have that we don't necessarily have is if you hold on to these investments for a certain period of time, they can be tax free. So there's advantages to holding on to these investments, which is what you want. You don't want people really trading these securities or wanting out. You have to wait for an exit, and these companies need to scale in order to get there. And so we're trying to push the government to come up with tax incentives and tax credits to help sort of foster and enable the industry to grow.
Yeah, I think that's huge. And very glad that you're out there working on that. Well, I also want to move on to the early stage or seed funding and venture capital. So this is something you're doing through it's D3 VC is your
Right.
partnership out there in Denver. And just give us a basic idea of where you're at. Can you tell us what is your current investment thesis?
So our whole thesis with D3 VC is VCs are moving upstream. Okay. Angels are trying to step in and play a role, but they only invest in their local communities. This is creating a complete funding gap out there for startups and many of the future unicorns that will be in our entire ecosystem in the next 5 to 10 years. So what we're saying is, if we can look at this data as a way to try and identify those future unicorns and invest in them at this earliest stage, we're going to have many outliers. So we built this algorithm off of our data to try and do that. We tested it. It took us a year and a half to build that. Then we were testing it for a year and a half. And from that testing of it, we started making our own investments. Then we formed our venture fund. And the goal with the venture fund is we want to invest in 200 companies over the next 2 to 3 years. We don't want to make, the entire investment. We want to make small investments in each of them, but we want to have 40 to 60 outliers. And we can believe we can do that because, if you just look at what, professors from MIT or Harvard have written about in terms of this, early stage venture funds outperform later stage funds by a multitude. And so that's our entire thesis is find these companies that are going to be the future unicorns and don't try and have one or two like a VC does, but let's aim for 40 or 60 in our data set.
Yeah, I love that's huge. So this is one way that you're using AI to sort of find, as you say, that needle in the haystack. And that's interesting to me because, the small number of angel investments that I've made, I'm out here in Michigan, and we've got some great research universities, but it's not really generally considered to be a sort of hotbed. However, we do have some very active angel groups that are looking to capitalize on all of that intellectual capital we have out here. So I think that's really cool. Obviously, you're hugely into data mining and AI. So what are some other ways that you're using AI to move the bottom line?
I think it's a combination of AI and machine learning. They sort of go together, because when you build algorithms like we do, where you've got live data, you constantly have to feed in the new data to the algorithm and retrain the algorithm on the new data. And one of the reasons why you do that is signals change over time. Look at exactly what's happening right now. We've got tariffs that are coming in. Companies don't know, should I even be going out to raise money? How is this going to impact, the bottom line for me? And so things are changing live. And when you have this data set like we have, you can constantly feed that stuff in. And then, you know what? You probably want to wean off what happened in 2016, because that doesn't relate to it anymore. So where you're using AI and machine learning to do that, you actually can be what we think is really forward leaning. And so we are on what we believe is taking into account current macroeconomic variables into these decisions that we're trying to make with our venture fund.
So I love it. Essentially, what you have is a sort of a model that directs you towards ideal investments. And then you also have a system that's telling you when maybe you don't trust the model, or at least the model as it has been functioning in the past. Perfect. Really
Oh,
beautiful.
yeah.
So yeah.
And oh, sorry. I just wanted to tell you, even with AI, AI is like your friend. It
Right.
should not be the decision maker. And,
Yes.
I think a lot of people are looking at this as, what AI can take the role of something. We look at it as this is just help us speed things up, but now it comes down to the decision. And you still have to do the things that venture capital does. We still have to research the team, their backgrounds, the IP, what are the patents, how are they protecting their moat? There's a lot of stuff that the human diligence is still there.
Yeah, love it. And sorry, I got to geek out on this stuff because in my background, I'm a former award-winning data scientist. So modeling and I would say model monitoring, those are two things that are huge for me. And yeah, I'm really feeling the love from the AI now. Yes, AI is your friend. That could be the leading quote for this. So love it. Classic. So email, website, carrier pigeon, or smoke signals. What is the best way for our listeners to reach out to Woodie Neiss?
Investomersbook.com. So Investomer with an S, book.com.
All right. Thank you so much for taking your time to share your knowledge and experience with our audience.
Appreciate it.